Here's a question for you, Caroline. It's similar to my earlier one. We all hear about what I would call greed and stupidity. And everyone who's trying to start a startup, he always talks about the hockey stick. There's 6 people in the billion people in the world, and I'll get 1% of it all. So give me $100 million. And no. Tell me about the creative finance of the startup that has more to do with myth and romance than reality.
100%. Great question. I think of successful companies having 3 legs, like a stool, right? Mm-hmm. And the first leg is they have to have an asset, right? Whatever that is, right? And for, say, for you guys, it's this podcast, right? It's an asset. The second thing is you have to have effective management, right? Management has to be good. They have to be operationally good. And if they've had success in the past, then they have a lower risk of not having success in the future, right? So there's the second thing. The third thing is capital. And money always follows good assets and good management. So where's the risk in that? The risk is, in general, it's in execution. So how do you get a lot of money? Well, you've got this brand new technology and you're going to start slow, but there's 100 million people on this planet that are going to really like your product. And so, if you take a small percentage, like 2% of that 100 million, and it's a $20 product, like the sky's the limit. That's a problem. So you make a forecast, right? You forecast out exactly on that principle, right? How big is your target market? What percentage of your target market's going to buy it? What's the cost of it? And that's going to be your revenue in the future. But we go back to that winning lottery ticket and the annuity, and you say, what's the present value of that revenue stream? And then where's the cost? So if it's a technology company, all those costs are up front, and you have to sink all those costs before your product's ready to go. But let's say a retail store, right? And that you've got to buy inventory every month or every year to sell in your retail store. So those costs are incurred just as revenues earned. But that technology company, you have to incur all those costs up front and pay all those back before you can show profitability. So it really comes down to how you are defining profitability and where your costs are, and ultimately how much you discount the revenue. So when it's me and I'm looking at a technology company like that, what I'm going to do is I'm going to look at the prior success of the management team and do a risk analysis on execution and determine, the value from that, discount that present value cash flow.